Welcome. In this explainer, we're going to open up a basic toolkit for understanding how money really works. We're talking everything from your bank account all the way up to the biggest global markets. I mean, it's a simple question, right? We all use money every single day, but the world it lives in, it's huge, it's complex, and honestly, it's absolutely fascinating. Because the real story of money goes way, way beyond your wallet. It's all about this massive global network, markets where trillions of dollars, euros, and yen are just constantly moving, being borrowed, lent, and invested 24/7. So, to make sense of all this, we're going to treat these big ideas like simple tools in an investor's toolkit. Each one has a very specific job, and I promise by the end of this, you'll know exactly what they do and why they matter. Okay, let's dive right in. The first and, let's face it, most familiar tool in our entire toolkit is cash. It is the absolute foundation that everything else is built on. All right, first up, we've got a key term, asset class. Now, don't let the jargon scare you off. It's really just a simple way of grouping similar investments. Think of it like this. You put all your screwdrivers in one drawer and all your hammers in another. Same idea. And cash, that's our very first asset class. For pretty much all of us, our financial journey starts with cash in a bank. But even here, you've got two basic options designed for totally different jobs. You've got your current or checking account. That's for your daily coffee, your bills, easy access, but you earn little to no interest. Then there's your savings account. That's for putting any extra cash to work to earn a better return. Now, this right here shows a really fundamental trade-off in finance. I like to think of it as a savings ladder. The higher you climb, which really just means the less immediate access you need to your money, the higher the interest rate you can usually get. It's basically a reward for your patience. All right, so let's grab our next tool. We're taking a step up from our personal bank accounts and into the world of big finance. But you're going to see that the core ideas, lending and borrowing, are exactly the same, just on a much bigger scale. Welcome to the professional leagues, the money markets. This is where the huge institutions, banks, governments, giant corporations, lend and borrow massive sums of money for really short periods, usually less than a year. It is all about managing cash flow on a grand scale. So the big question is, how do you get in on this? Well, you can't just walk in the door. The minimum investments are often enormous. Instead, regular investors like you and me can get access indirectly through something called a money market fund. It's pretty clever. It just pools together smaller amounts of money from lots of people to get a seat at the big table. And a perfect example of what you'd find in this market is the Treasury bill, or T-bill. All it is really is a short-term IOU from a government. You might buy it for, say, $99.50, and when it matures in a few months, the government pays you the full $100. And because they're backed by governments, T-bills are considered one of the safest investments on the entire planet. Okay, it's time to add a truly massive tool to our kit. We are going global now, into the single largest, most sprawling market on Earth. Just look at that number. That's over $6 trillion. That is how much money moves through the foreign exchange, or FX market, every single day. It completely dwarfs every stock market in the world combined. And why? Well, think about it. Every time a car is shipped from Japan to Europe, or a tech company pays its staff in India, currencies have to be exchanged. This market is the engine room of global trade. And a huge reason it's so big is that this market never, ever sleeps. It's not a physical place, you see, it's a global network of banks. And as this timeline shows, the market literally follows the sun around the world. It kicks off in Sydney, moves to Tokyo, then London wakes up, and finally New York. It's a nonstop flow of money, 24 hours a day, all week long. Now, in the FX market, you never just buy a currency. You're always trading them in pairs, buying one by selling another. So a quote like EUR/USD is just a price tag. It tells you exactly how many US dollars, that's the quote currency, it costs to buy one single euro, which is our base currency. Simple as that. Okay, our next tool is an absolute cornerstone of the financial world. It's a fundamental building block for long-term investing and for how governments finance themselves. Let's talk about bonds. Seriously, forget all the complicated jargon you might have heard. At its absolute purest core, a bond is just a loan. When you buy a bond, you are simply lending your money to a government or to a company. That's it, full stop. And every single one of these loans has four key parts. You've got the issuer, that's who's borrowing the money, the nominal value, that's the loan amount they'll pay back at the end, The coupon, think of that as the fixed interest they pay you for lending them the money. And finally, the redemption date. That's the day you get your original loan back. But, holding a loan, even one you can trade like a bond, isn't risk-free. Now that we know what a bond is, let's look at the single biggest thing that can change its value before it's due to be paid back. Okay, there is a simple seesaw relationship between interest rates and bond prices. It's super important. If interest rates out there in the economy go up, then any new bonds being created will have to pay that higher interest. Suddenly, your older bond with its lower fixed payment looks less attractive, right? So its price has to fall to compete. And as you'd expect, the opposite is also true. If interest rates fall, well, now your existing bond with its higher locked-in interest rate looks like a fantastic deal. More people will want to buy it, and so its price goes up. It's a core concept for any bond investor. The other big risk to think about is, what if the issuer just can't pay you back? That's called default risk. And to help investors figure this out, rating agencies grade bonds. The safer ones, investment grade, come from super stable companies and governments. They have a really low risk of default. Then you have high yield, or as they're sometimes called, junk bonds. They're riskier, for sure, so they have to offer a higher potential return to make it worth your while. And there we have it. We have just unpacked 4 essential tools from the Financial Markets Toolkit. We've got cash, money markets, foreign exchange, and bonds. Each one a totally different way of putting money to work. At the end of the day, just like any good toolkit, there's a right tool for every single job. Whether you're just trying to keep your cash safe for a rainy day or lend it out for the long term, understanding what each of these tools does, that's the critical first step toward making smarter financial decisions. So, we've opened the toolkit. The only question left is, which tool are you going to pick out first?